Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 10, the Group B problems. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. All right, so let's jump down to the next one, 57. All right, so it says here, accounting for cash dividends. Kaluna Consulting has 8,000 shares of $5 no par preferred stock and 70,000 shares of no par common stock outstanding for 2012 to 2014. Kaluna declared and paid the following dividends during a 3-year period: 22,000 for 12, 95,000 for 2013, and 225,000 for 2014. A. Compute the total dividends to preferred shareholders and to stockholders, common stockholders, for each of the 3 years if, excuse me, if preferred is non-cumulative and if preferred is cumulative. Okay, so the first question that we're going to have to ask ourselves here is, if dividends are paid out to preferred stock, right? Remember, preferred, they get the, they're in first position, okay? It just popped into my head. It's sort of like a mortgage, right? If you have a mortgage on your house and you finance it through a bank, the bank has the first position. If you go and you take a another mortgage or a homeowner's loan or whatever have you, on the equity as a second loan against that house, that second loan is in second position. So if for some reason the house gets foreclosed on and the bank can't sell it for what it's worth, whatever they sell it for, that amount of money goes to the initial the initial bank that made the first mortgage, and anything left over then would go against the second mortgage against the home equity loan. So same type of thinking. Preferred goes first, then common. All right, but here we're looking at 8,000 shares of $5 no preferred stock. Okay, so we have 8,000 shares at $5. That means the preferred dividends per year is 40,000. Okay. Now, we're going to look at the situation if preferred is non-cumulative. So in 2012, all right, it says here $22,000 is what was declared in dividends. So if in 2012, the full 22,000 would go to preferred stock, right? Because they're owed 40,000 a year, right? Anything in excess over the 40,000 would then go to common. But because there is no excess, nothing more obviously goes to common. And since this is non-cumulative, the difference between the two of 40,000 less 22,000 or 18,000, that difference does not get carried over. It would only be carried over if it was cumulative. Okay, so the full 22,000 goes to preferred stock for 2012. For 2013, there's a $95,000 dividend. Okay, so in 2013, since there's 95,000 available, right, the first 40,000 of it goes to preferred. So preferred would get the 40,000, and the difference between the two of 55,000 would go to common stock. Okay, but there's nothing carried over because this is non-cumulative. I'm only talking about non-cumulative here. Now in 2014, there's 225,000 carried over. Right? So out of the 225,000, 40,000 goes to preferred, right? And that leaves 185,000 left over for common. So preferred gets the 40,000 and 185,000 goes to common stock. Okay, that's what it looks like from the perspective of non-cumulative, right? Non-cumulative, meaning nothing is carried over. Preferred gets looked at first. It gets paid what it's owed, but if it doesn't, if anything that's still owed does not get carried over to the next year. Right? So pause the video and write all of that down if you have to, because I'm going to erase it. Or at least I should say I'm going to erase a portion of it. Or maybe I'll erase all of it. We'll see. Okay, so we're back. And now we're going to look at it from the perspective of cumulative. Now, yeah, I'm going to erase all of it here and work it from a clean slate, because really the reality is you're never going to do both. Okay, it's going to either be one or the other. It's going to be either non-cumulative or it's going to be cumulative. And remember, if it's not stated, then we assume it's cumulative. All right, so for 2012, it's $22,000. Right, so for 2012, I'm going to say I'm going to write owed here. All right, so in 2012, preferred is owed 40,000. Right, and the dividend is 22,000. So the 22,000 is going to go against preferred, right? But for 2012, 22,000. That means for 2012, preferred is still owed 18,000, right? Now for 2013, the dividend was 95,000. Okay. Well, I should let me erase this over here and make this preferred stock over here and make this common stock over here. So the preferred stock will be 22,000 going against the 22,000 will go to preferred stock, and common stock will get 0. Okay, that's just rearranging that information. So now we have 95,000. Okay. Well, in 2013, and I'm going to do this in blue, preferred is owed an additional 40,000 plus the 18,000 from the previous year. Okay, so out of the 95,000, preferred is going to get $58,000. Okay, now 95,000 less the 58,000 is not 3, 7 is $37,000, right? So the remainder, right, is 37,000. So 95 minus the 58 is equal to the 37,000. So for 2013, 58,000 will go to preferred, 37,000 will go to common. Now I'll do the next year in green. So for 2014, right, the dividend is 225,000. Okay, the amount owed to preferred is 40,000. All right. Now, since everything was paid off from the previous year, there was nothing carried over. 40,000 goes to the preferred shareholders. Okay. And the difference between the 225 less the 40,000 is 185,000. So 185,000 goes to the common shareholders. Okay. And that's it for doing number 1 here. All right. Now it says here, 2, for case 1B, journalize the declaration of the dividends on December 28th and the payment of dividends on January 17th. Use separate dividend payable accounts for preferred and common stock. All right, let me see here. I'm going to try to write this all because I want this information here. So I'm going to just kind of like try and squeeze it in here. All right, so on 12/28, let's see here, it says journalize the declaration of the 2014 dividend on December 2018. So we're talking about this $225,000 dividend, right? So that's going to affect our retained earnings. So I'm going to debit retained earnings for the $225,000, and I'm going to credit, all right? Well, I owe the $40,000 to preferred, so I'm going to credit dividend payable preferred for the $40,000, and there's $185,000 for common of $185,000. Okay, so that's the declaration. That's the journal entry for the declaration. And notice we're using dividend payable, right? So that's money we owe, right? Because that's a liability account. We're declaring it. We're taking it out of our retained earnings, so it's no longer, part of the profitability of the company, and we're moving it over to our liability accounts, the dividend payable accounts, to be paid out at a later date as something we owe. So that happened on December 28th. Now on January 17th, right, we're going to actually pay it out. So on January 17th, we're going to debit. Actually, let me do it in blue. So on 1/17, we're actually going to pay it out. Well, what are we going to pay out? We're going to pay out what's owed. So we're going to debit the dividend payable preferred for the $40,000, and we're going to debit the dividend payable common for the $185,000, and then of course we're going to credit our cash because we're paying it out for the whole $225,000. Okay, so notice that. So that's it for the journal entries. I mean, there's nothing else to say about the journal entry. The only thing that I'm going to point out here is that, remember, this is, and I explained this back in the theory videos, but I'm going to cover it again real quick. This is nothing more than the same exact thinking of accounts payable or accounts receivable. I mean, you already know this information, but associate it so that you can remember it. Don't try to memorize this all over again. Notice that with accounts payable, let's just use an accounts receivable. If somebody buys something, you're going to debit accounts receivable for a certain amount, and you're going to credit the revenue, right? Well, this revenue is very much like our retained earnings, right? And the accounts receivable is the dividend payable account. So when somebody takes out, when somebody buys something on account, you debit the accounts receivable, and when they pay it off, okay, you're going to receive the cash, and you're going to credit the accounts receivable, right? Actually, I should have done this back the other way. Oh, it's the same thinking, okay? What happens is the accounts receivable as a debit washes itself out as a credit, right? And you're left with the revenue and the cash. If we look at it from a accounts payable perspective, we're looking at the same exact thing. And this is probably more applicable. I just picked the wrong one. So let's take a look at it here. You debit, say, supplies expense, right? Because you buy something from Home Depot, and you credit your accounts payable, right? Well, this supplies expense is like retained earnings. And this accounts payable is like the dividend payable accounts, right? So we owe the accounts payable. Now when we pay it off, we're going to credit our cash. Oops, make space here. We're going to credit our cash, and we're going to debit our accounts payable, right? Again, the accounts payable account is our dividend payable account. So what are we left with, right? Well, this debit and credit washes out the accounts payable, and all we're left with is this debit to supplies and this credit to cash. Well, if our supplies is like the retained earnings, which is what we have here, and we have our cash here, this credit for the dividend payable wash each other out, right? $40,000 credit, $40,000 debit, gone. 185,000 credit, 185,000 debit, gone. So what are we left with? A debit to retained earnings and a credit to cash. All right, it's just as if we took it right out of retained earnings and we paid cash, just the same as it's as if we bought something for supplies using cash. So you already know how to do this, all right? I just want to point it out so that you can associate it to the thinking behind it, all right, instead of trying to memorize all of this. If you can associate it, it's just that little bit more easier to remember. Okay, so with that said, again, you don't understand it, watch the videos again, go back and watch the theory videos, and if you still have questions, feel free to contact an instructor.